Welcome back to the Old Fashioned Real Estate Show. I'm Brian Leverage.
I'm Jeff Holst.
Yeah, very subdued.
I don't know if you knew what my name was. I was waiting for you to introduce me.
Well, this is only the second episode we filmed today, and neither of us has really hit the bourbon hard.
Fair enough. So you do remember who I am. So we have a really interesting topic today, though. Today we are going to talk about the pending real estate market crash. Hearing a lot of people talk about it, and right after this, we're going to tell you why we don't think it's coming.
Or is it?
Welcome to the Old Fashioned Real Estate Show, where hosts Brian Leverage and Jeffrey Holst pour out old fashioned real estate advice.
Welcome back. That was an enlightening episode. I hope you enjoyed it. Oh, wait, we didn't film the episode yet. That didn't work. So here's the thing. Full disclosure at the beginning of this episode, neither Brian or I have a crystal ball. We don't actually know for sure what's going to happen. But we do think about these things a lot because we're heavily invested in real estate. And so we're really interested to know, our real estate market, is pretty hot right now. Most markets that we follow are pretty hot right now. So the question is it going to stay this way? And if so, for how long? Now, we did a previous episode about this all the way back in 2019, I think, called Real Estate Market Cycles. I think it was around episode 13 or so, and I'll put that right up there. That will give you a kind of a primer in how we think about the market cycle in general. But this market is unprecedented. And so we wanted to talk about where we are right now as we sit here in May of 2021. Yeah. So, Brian, what's going on in the real estate market right now?
A lot.
That's true. Fair enough.
To expand on that, prices are up, right? Of all asset types. We're not just talking about single family, commercial, multifamily, etc. And not by an insignificant amount year over year. I mean, we're seeing double-digit inflation in
real estate prices,
yeah.
and frankly, also in component costs, right? Lumber prices are up. Paint costs more than it used to. Flooring costs more than it used to. Every single thing costs more, which means the cost of construction has gone up dramatically. And of course, that means replacement cost has gone up dramatically. So across the board, we're seeing prices rising. In Chattanooga, we're seeing the same thing in Michigan and other markets that I follow. Quite simply, the market is stupid hot.
It is. And some of this that we can't really know to a great extent is, it's fueled by monetary policy with the Federal Reserve, here in the United States and other reserve banks around the world. But then there's also supply chain issues we've had for the last year and change. COVID, for better or worse, I'd say most would argue worse. A lot of those disruptions, we're still feeling the impacts on today.
Yeah, so it's really interesting. So we talked about this on a previous video about how the supply of real estate for sale is down dramatically, both in Chattanooga and all around the country. One of the reasons that we had heard that the supply was down was because people didn't want to move during COVID. Yeah. Right? They were afraid to do open houses and things like that. Now, to a large degree, that's been mitigated and supply has still remained really, really low. Part of that could be because of pent-up demand, right? People that weren't buying last year are now buying this year, which is putting upward pressure on the market. But another part of it seems to be that there's just a lot of demand for property. There's a lot of money out there, right? Rents are going up for the same reason. We're seeing in one property that Brian and I own, 20 or 25% rent increases above what we expected 6 months ago.
Yeah.
I mean, or 8 months, let's say. But it's still an insane increase in rental prices in a short period of time.
And for a property that we'd argue was not substantially below
market.
Yeah,
this was a stabilized...
in the first place.
This is the only property that you and I bought last year that we looked at and went, it's just a solid long-term hold. It wasn't a value-add play. It was basically fully renovated and ready to go. No idea. We thought, hey, maybe rents can go up $25 a unit or something, which is not that much. It's a 12-unit building, so it's not a huge amount of money. And now we're seeing maybe as much as $125 instead of $25, which is just unbelievable increase. And I think a lot of this comes from what you alluded to a moment ago, which is there's an enormous amount of excess capital. So two things happen. There's been a huge amount of stimulus. Some people say as much as $6 trillion in stimulus in the United States in the last 12 to 13 months. And at a time when people couldn't actually spend the money, things were shut down, so they didn't have anywhere to spend their money.
And I think in talking to one of my bankers over the last few months, he's mentioned more than a few times the U.S. savings rate has been at an all-time high.
Yes.
For basically the last year.
And now a word from our sponsors. Who's sponsoring us today, Brian?
Well, we are, Jeff.
We are. How
Yes.
amazing. So we want to tell you about how you can save an enormous amount of money on your taxes and how Brian and I have been able to eliminate our taxes entirely.
You guys need to learn about cost segregation, which you can do by going to our website, oldfashionedtaxsavings.com.
Yes, and if you go there and you fill out the form, you can get a free, no-cost benefit analysis that will show you how much money you can save and what it will take to do that. Yes, and you know the effect of a lot of money going into the economy is because of the way money multiplies itself. When you deposit money into a bank, the bank can lend it out 10 times, right? Because they only have to keep a 10% reserve.
That's fictional reserve lending.
Yeah, I only have to keep
really
a 10%.
Fractional, but
But the point is, the M2 money supply has gone up dramatically. If you look at the chart on the, there's a website called fred.org, which tracks the money supply from the Federal Reserve. If you look at this, and I'll put this in the show notes as well, but if you look at the money supply going back to the 1950s, it goes like this. Slowly creeps up, right? So this is the baseline and it just kind of goes up. When you get to 2019, it goes like this. Like it literally doesn't hockey stick, it almost goes straight up. It is an unbelievable chart to look at and I wish I had a graphical representation of it here, but alas, I did not bring my whiteboard. But the interesting thing is the money supply has gone up 25% in the last 12 months from 10 trillion to almost $13 trillion.
that's a lot of cash.
Oh yeah, $3 trillion in extra money available. And then when you apply the money multiplier, of course, it's even more, right? So there's just tons and tons of extra money in the system, which causes a lot of upward pressure on assets. And that's kind of what we're seeing. So because of that, unless assets have gone up more than 25%, there's a legitimate argument that we're not about to see a crash. Like, I've been sitting around going, I should sell some stuff. These prices don't make sense. I've even thought about selling my own house because the market's up so much. You know, I bought my house for $200,000. I don't mind sharing that because it's public record. But I bought it for $200,000 7 years ago. I thought last year, about this time, I might sell it for $275, maybe $300, and now I'm thinking I could sell it for like $375.
Or four, yeah.
Yeah, or maybe $400. I mean, the market is crazy, and I'm like, I should take that money and put it in the bank. But the thing is, if the money supply has increased as much as it apparently has, it might be worth 25% less. So 300 might be the new 400, or vice versa, actually. So that's just something to think about. So what do you think? Are we going to see a real estate crash in the next 12 months?
It's hard to say because I don't, because real estate is typically a lagging indicator, or at least residential is, certainly. And so, you know, when you look at employment numbers and so forth, and of course these things are regional, right? I mean, we're having this discussion on a macro level, like nationally.
Yes, which is, there's not really such a thing as a single market.
Right. So I don't know that that we will see a crash, right? And the other part too is you look at underwriting standards on residential being, you know, much sounder than they were, previously.
That's actually a really interesting point. A lot of people are pointing to 2005, 2006, and the huge run-up in real estate prices that occurred then, and they're drawing parallels between what happened in 2005 and 2006 and what happened now. But there's a couple of crucial differences. One is the money supply is a lot higher now, which it didn't go up dramatically in 2005 and 2006, which you can see by looking at that chart I said. But there's another difference in that is that the underwriting standards, in other words, the availability of capital, while interest rates are very low now,
Is restricted.
even compared to then, you're still looking at, does the person have income? How long have they been employed? Can they afford to make the payments?
In the early 2000s, your qualification to get a home loan was essentially you could fog a mirror.
Yeah, I mean, quite honestly, like in 2006, right after I got out of law school, I qualified for a $250,000 mortgage. I didn't end up getting that much, but I could have borrowed that much. And what they said to me is, how much money do you make? And I told them a number, and that was it. Mm-hmm. It was called a stated income loan.
Liar's
and they were
loans,
like, yep, no problem. And no, I didn't lie.
I know you did.
But the point is,
no
one ever asked me. I was
no documentation.
Self-employed. I'd only been working for myself for 6 months. So, like, there's no way that I should have qualified for a $250,000 mortgage. And considering that was a lot more money then than it is now.
And ironically, at that same time, I was working construction in Los Angeles, California, and with some investors who were flipping houses, and they were carrying too much paper, even then, in a very lax lending environment. And so they got me qualified for a $950,000 loan without having to put anything down at that time. And I remember thinking, if they're going to give me that much money, this isn't going to end well for all of us.
Yeah, I mean, and in fact did not end well for a lot of people. And I would recommend people check out The Big Short, which goes into this in a lot of detail. And maybe we'll do a whole episode about the mortgage crisis at some point because it's fascinating stuff. But there's a counterpoint to this. We have a friend of the Old Fashioned Real Estate Show, Harry Dent. Yes, so Brian and I recently had lunch with Harry when we were in San Juan, Puerto Rico. So that was pretty fun.
It was.
But Harry has been saying for a long time that all of this stimulus is just staving off a pending crash, right? So what do you think? Is Harry right? Is a crash coming?
I mean, eventually it has to happen, right? I mean, nobody knows when, right? And that's the quadrillion-dollar question in an inflationary environment such as ours. But
assuming we even have inflation. It seems like inflation is here, but Harry's been predicting deflation before inflation for years. In fact, he told us that as recently as a few weeks ago.
Yeah.
So you heard it here first. Brian Leverage thinks Harry Dent's wrong.
Brian Leverage did not say that.
Oh, no, Harry. He definitely said that. And we know Harry is a big fan of our show, and he's definitely watching this episode. So, Harry, Brian gives you the giant FU. Cheers.